Hello, good afternoon, and welcome. Thank you all for joining us today for our mid-year energy briefing. I'm Allison Chen, partner in charge of the firm's Houston office, and it is my pleasure to welcome you all to our events today. So Akin Gump hosts our energy briefing biannually in January and in the summer to share with our clients and friends of the firm insights into topics that we believe will impact how energy companies conduct business in the months ahead. And we're so delighted today to be able to host this summer's briefing in person as well as online. So before I introduce our fantastic lineup of speakers, a few housekeeping items. So there are two panels for today's briefing, and to help us stay on schedule, we will reserve Q&A for both panels until the end of the program and after both panels have concluded their presentation. For those online, please submit questions as you have them throughout the in the Q&A function. For those that are in the room, please hold your questions until the end of the program, and we will hand you the mic at the appropriate time. Today's presentation is eligible for CLE credits. So please refer to the email that you received yesterday. And for those online participants, simply fill out the form, link to that email, and send it to the contact person noted. Today's CLE code is 713 Energy, and we'll post this throughout on our slides. For those in person, I think you've already signed in downstairs, but if you haven't, there will be an opportunity on your way out. Our CLE team will help report your credits on your behalf to the California, Texas, New York, and Virginia Bar Association. In today's slides and program recording will be circulated to all registrants. And finally, I would like to welcome members of the media who have joined this on the record briefing. And I encourage you to reach out to us with any follow-on questions you might have regarding anything we covered today. So with that, I'm pleased to introduce the speakers of our first panel, Market Outlook, Trends in the Energy Transactions. And I'll start from my far right. Blake Webster is Managing Director at Quantum Energy Partners and is based in Houston. Blake has worked with Quantum for the last 16 years, focused on building companies in both the traditional energy and energy transition sectors. His primary responsibilities including serving on portfolio company boards and originating new investment opportunities for the firm. Next to Blake, we have Avril Khan. Avril is Senior Counsel for Vitol here in Houston, and she's primary in-house counsel for Vitol's power and energy transition activities in the Americas. Over the past several years, Vitol has invested or committed over $1.3 billion in solar, storage, wind, renewable, natural gas, and EV fleets in Americas alone, and including over 550 megawatts of operating wind assets and approximately 300 megawatts of solar assets, either in operation or under construction. So she is a busy woman. Next to Avril, we have Guy Oliphant. Guy is co-head of America's Upstream Investment Banking at Jefferies, also based in Houston. Guy primarily covers domestic E&P companies, both private and public. With a focus on M&A and private capital raises, he has been with Jefferies for over 19 years, almost 2 decades.
Don't say it.
Welcome. And moderating this first panel is my partner, Wes Williams. Wes is in our corporate practice group in Dallas and co-lead of the firm's energy team. He has more than 2 decades of experience structuring transactions across the energy sector. With that, Wes, I'll turn it over to you.
Thanks a lot. Thanks a lot, Allison. And thank you very much to our panelists. So I thought today we'd go through several questions on just what we've seen in the past with respect to hydrocarbon transactions over the course of the last 12 months or so. We'll talk about kind of what's going on today and what we expect to see in the future. We'll also touch not only on traditional hydrocarbons, but we'll talk a little bit. We'll have a couple of questions that you guys can respond to with respect to energy transition and renewables. So with that, and maybe Guy, we'll lead off with you. Over the last 12 or so months, what have you guys been seeing at Jefferies with respect to traditional hydrocarbon transactions?
Yeah, thanks. I think this question, as I kind of thought about preparing for this meeting, led me to a little bit of what's useful is kind of gaining perspective for where we are. I was talking to one of our peer banks the other day, and they said they're having a real trouble keeping morale up because the deals are hard now. And I thought to myself, if I would have offered anybody in the oil and gas business an opportunity to live in the world today in the midst of 2020, when we were all trying to figure out maybe what green hydrogen was, we would have taken this, 10 times out of 10. So said simply, we're in a worlds of better environment than we were in 2020. That's I'd say a fairly low bar. But I think importantly, overall, the perspective on the business is much better in the long term. We've got, I'd say, 4 major trends going on in the upstream M&A world. One, which is somewhat atypical in our industry, even in good times, is the public investors are rewarding M&A. And if you said what the bellwether of a good M&A market is where public companies are active acquirers of businesses, that's a very good leading indicator, because for the most part, our public company clients want to grow their businesses, and they're in a world where their investors will allow them to do so. That's a good start from the M&A environment. Additionally, for our seller clients, like Quantum or other sponsor firms, we've got public company balance sheets that are highly supportive of cash M&A. So if we think about our business over the past decade, for most of our transactions with the public buyer, that would be half to 2/3 stock, outside of when we sold assets to Exxon, et cetera. And now even our smaller independent buyers are paying 2/3 or 80% cash. Why? A simple reason: they have it. And they think their stock is undervalued, so they don't want to issue a lot. 3, we've got a really liquid market across all the basins. So there's times we sell Permian assets or PDP assets in general. There's a bid for every asset class. And I think last, this is somewhat of a niche comment for people who are focused on E&P. We've got a real focus on inventory, and I think a real trend will be depth of inventory, quality of inventory, for a bunch of reasons that I'll talk about later. But I would definitely raise my hand and say I'd take today's environment despite some volatility, and happy to be having this conversation.
And so let's kind of carry this down the table, because each of you brings a unique perspective to it. You've got the investment banker, you've got a large strategic, you've got private equity. So April, what have you seen over the course of the last 12 months, just kind of leading up to now?
Mm-hmm. So I think the last 12 months, certainly in the power and renewables sector, has been very active, both in M&A and kind of new projects. There are, and we'll discuss this a little bit later, headwinds to a lot of renewable projects that I do think, kind of despite sort of stated goals, both nationally and internationally, are going to kind of slow the quote unquote energy transition down a bit. But certainly on our end at VTOL, and I feel like I should say, just as the lawyer in the room, like, my opinions are my own, not VTOL's. But, on our end, we are still actively in the market, both as buyer and seller. We just closed on an acquisition of 3 additional wind farms in PJM, actively looking at other opportunities in solar, battery storage, carbon capture, RNG, biodiesel. There's just a lot going on. Certainly on the upstream side, I know we're active there as well. So it's certainly, as Guy put it, a much better time than it was 2 years ago.
And Blake?
Yeah, maybe I'd just add a couple things. I think Guy summed up the overall traditional energy market well. I would just add that, when you look at where we were in 2020, I think, the amount of asset supply that's come on the market in the last 12 months has been pretty staggering. But I think that dovetails with where the commodity has gone. And as these companies, both public and private, have revamped their business models, generally more towards a capital efficient or return of capital focus, where they can kind of develop their best inventory, distribute cash flow. I think that's also facilitated a lot of these transactions. And so, I think the question, and we can talk more about it later, is just, with all this supply, will there be enough cash to see all these deals clear? Obviously, there's been more volatility in the market here recently, but, from where we were 12, 18, even 18, 24 months ago, it's a great market.
Yeah. And have you guys seen, like, on balance, I mean, April, you see a lot of the renewable stuff, but on the traditional hydrocarbon deals that you're seeing, are they primarily upstream deals, Guy, Blake? Either one of you can jump in. Or have we seen an uptick in any of the midstream deals, or are we seeing that?
Yeah, I'll take that briefly. I mean, we've generally found in our business, and we have a very large midstream practice as well, is the midstream is typically lagged upstream, and sometimes that's good. Certainly, when we face planted in 19, midstream still had some room left, and now we've been busy for 18 months, and I would say our midstream practice is probably 6 months behind that. So I think we are seeing more. I think the midstream business has a little bit of the same issue of our business, which Blake points out is somewhat of a lack of a buyer universe. So even if public companies are buyers of the assets, there's a relatively discrete number of public companies who are buying things that are tactical. Whereas when we sold things over the past decade, it was, I'm not here now, so that means I've got to be there. There's less of that. But yeah, I think in general, the slower evolution, and Blake will actually be much better to speak about this, is the formation of private capital to come back into the space, which historically energy was a highly disproportionate amount of private credit and equity. Now it's a highly disproportionately small amount. And I do think there's green shoots on that. I don't think that's going to be overnight phenomenon, but for upstream and midstream, the businesses now have a lot of characteristics of what private capital should like, and that it's very stable, particularly in midstream cash flows, but even on the upstream side, still highly cash flow generative and high current cash yields.
Yeah, I'd say these, speaking to the midstream side, I mean, these businesses have been very resilient. As you've seen more development return to the industry, I think in terms of the strategic bid, you've seen a couple of years where they really weren't doing any transactions, really focusing on their own balance sheet. But, now it's just, okay, I could issue out more cash flow, or I could do some tactical acquisitions that fit in with my business. And you've seen, quite a few of those recently. You just sold one of our private portfolio companies to Williams, along that similar theme.
Yeah, and it's interesting because we're seeing kind of the same thing, from the legal side, that, a lot of the stuff that's driving a lot of the A&D in the traditional hydrocarbon space has really been upstream over the course of the last 12 months. And, we do have sporadic midstream deals that we've been working on, but by and large, it's been a ton of upstream work, and hopefully, to your point, hopefully, for the benefit of the lawyers and the bankers, the midstream will follow the upstream. So kind of looking forward, I mean, I think we've sort of hit on this. What do you guys see like in the second half of this year? What are the main trends that you see kind of happening as we enter into the second half of this year with respect to traditional hydrocarbons, or April, with respect to renewables on the M&A or A&D side?
You want to start?
Sure. So we'll just go in order, I guess.
Sure.
So what I would say is appetite for M&A is very high, but we're in a period of just significant volatility, which makes deals hard. And this is generally, I think, what people have their kind of head in their hands over. If you say, why are they have a negative bent toward the M&A market? It's just volatility is making deals hard. To me, that's just the way the world works. And then you get in a period of less volatility and deals get easier. I think the other really significant issue we have in our business for selling to public companies is just the public company valuations. Devon Energy has a $40 billion market cap, infinite inventory, investment grade credit rating. And oh, by the way, it trades at a 10% dividend yield and a 4x multiple. So if you run that business, you don't wake up every day excited to issue a bunch of equity against that valuation. And so in general, the public companies are still active deal doers, but they're staring at their stock saying, am I going to go issue my stock at this point in the valuation to buy somebody against a strip that's highly volatile? The good news to me, again, I don't think this is very sustainable. The businesses are going to generate record profits and probably more importantly, record distributions this year, plenty of visibility to do so going into next year. So I think this is just a little bit of a market correction. So long story short, Wes, I think we're going to go through a period that's pretty choppy here. Just we have depressed valuations and we have high volatility. I think that's a 3 or 6 month phenomenon that we may just have to live through. But I think there's a lot of light on the other end of that phenomenon.
certainly from, the VTOL perspective as a commodity trader, volatility in commodity prices is generally good for business. It does create potentially some cash constraints that certainly impact some of our decisions. As we look at sort of the renewables and energy transition space, I think there continues to be sort of a gap between where we want to be and where we are sort of collectively. Kind of going back to some of the headwinds that we're seeing on the supply chain side, a lot of these projects, equipment is sourced out of Asia, particularly Southeast Asia on the solar side, kind of ongoing issues as it relates to tariffs and investigations by the Commerce Department, just kind of slows a lot of these projects down. Certainly we see an increase in costs that's somewhat offset by increase in power prices in the United States generally. But a way a lot of these projects are done and then ultimately financed and sold is that, you've got revenues that are locked in relatively early on through some kind of long-term offtake agreement. But then if you're seeing rising costs in the interim between when you sign that agreement and when you're actually executing the project, I think we are seeing more and more developers and sponsors getting squeezed. So I think we're going to start seeing some more kind of, maybe not necessarily distressed projects, but projects that no longer make sense, absent kind of going back to the table and having to do some serious renegotiation. There's also issues in terms of getting these projects built in terms of interconnection queue. So, for those who don't know, in PJM, so sort of the Mid-Atlantic, they've essentially kind of put a stop on new interconnection until they kind of figure out the process. That process now is taking potentially several years for projects to get interconnected or interconnection agreements signed. So again, kind of further slowing development from an M&A perspective. I think where there are late stage development projects that have signed IAs, that have, binding purchase orders from equipment providers. I think those are projects that go at a premium. And then I think in the interim, we're going to see a lot of kind of sort of confusion around sort of how to value and potentially like what to do with these projects in the kind of near to midterm that are seeing the increased costs that maybe aren't going to be able to enjoy the increase in commodity prices. And so I think it's just going to be an interesting period over the next year or two until some of those issues kind of sort out.
Okay. And Blake, from the private equity side, I'll hit you with two. So we'll do this back to back. The first one will be traditional hydrocarbons. Are you guys buyers, sellers over the course of the next 6 to 12 months? Are you both? Are you weighted one side or the other?
Yeah, I'd say we're both. I mean, and really with, a series of staggered funds, we're always in the market buying and selling. And so, to Guy's point earlier, we really like more stable markets because it's easier to get deals done both on the buy and sell side. So we've hit a little bit of an air pocket here. I still think that the fundamentals for energy are very good, but I do think just over the next 6 to 12 months, just those macro considerations, where does inflation go? How far does the Fed have to go to rein that in? What does that do with the broader economy? Some other international considerations, Chinese lockdowns. These are all things that are kind of grabbing headlines. So the macro can overwhelm the micro fundamentals of energy, which I think are good at the moment. So I don't know if that got to the first question.
That's, and I'm going to actually hit you with three. So the 1B is, so are you guys seeing additional management teams coming in? It seems like the funding for new management teams is way off, and it has been for quite some time. Do you see that picking up at all just because of the uptick in the commodity?
I'd say, look, I think there's been more of a shift in our space around just, how many teams a sponsor will support. I think earlier in the shale revolution, it was more common to see, earlier stage business plans, more kind of land driven, backing a team, establishing a footprint and then selling out. I think we've tended to, our view has been more, fewer companies, larger commitments, build companies of scale. And so that's just naturally kind of trended that number lower. Mm-hmm. But we're absolutely in the business of, finding great partners, and that doesn't mean that has to come with assets day one. So I just think the overall amount of teams that are going to be active, given the scale requirements to operate in today's world. I just think it's going to be a smaller subset.
Okay, and so then that's 1B. Question 2 is really from a private equity perspective. I mean, Quantum has always been historically, marketed as an energy family of funds, right? And that energy runs the gamut from traditional hydrocarbons to renewables. Or have you guys seen an increased focus, towards the renewables or energy transition, or sponsoring those teams that are really targeting those types of assets? And kind of what was the driver of that, if you have seen an uptick there?
Sure. Well, look, I'd say, for us, a little bit of a background, we have our flagship fund, which is a growth equity fund. We invest across the energy spectrum, as Wes said, both traditional energy and energy transition. Although I don't really love that term. We typically say energy addition because, I think fossil fuels and traditional energy are going to be here for a lot longer. But I think, today that's probably, out of our flagship fund, probably a quarter of what we do. We've been doing renewables for a long time. We also have carbon capture projects and other, EV related investments as well. But I'd say the driver of that, look, I think we really need both. And I think our pitch to LPs is, as the GP, we're not going to raise a discrete fund to just focus on transition and just traditional. We're going to do both and then allocate capital based on where we see the most opportunity. I think the other benefit is it really helps us as informed energy investors when we're really, at the investment committee looking at both, areas of investment. So we think it's something that we're going to continue focusing on. I think you're going to see more energy transition, investing across our space. I'd say, a lot of those areas are still very, immature and kind of younger. So some of these areas that, take carbon capture, for example, I think that makes a lot of sense, for both, groups like us who have subsurface expertise. We know how to build infrastructure. We think it's certainly, something that's, needed, longer term. But, that industry feels today more like venture capital than it is infrastructure. Eventually, that'll be a huge infrastructure asset class. But I just think those things will take some time to play out.
And Averill, do you have thoughts on that as it relates to kind of carbon capture? Blake raised the point that it feels a lot more like venture capital. I think that you guys have played in that space a little bit. And so are you seeing kind of the same things and you view it similarly?
We have, in fact, looking at Kevin Juneau, who's in our audience, who's our director of carbon capture now. But no, we're absolutely interested on the VTOL side in carbon capture. I think Blake's right that it's still nascent. I think some of that is some of the uncertainty that's being created right now in Washington around 45Qs as they currently stand. They're really not quite rich enough, frankly, to incent the kind of investment in the space that I think the government wants. So I think, there's work to be done on the Hill to kind of, help kind of move carbon capture from, I think we're kind of past where it was maybe 10 years ago as a true kind of science experiment, but now where it really is that kind of high risk venture capitalist style investment versus where you really see, strategics and large corporates like embracing it and really moving, at it full speed.
Yeah. And I think we were talking earlier with respect to funding these things, and it's so difficult now to actually thread that needle, and you don't really get a first mover advantage, right?
No. I mean, so I worked on Petronova when I was at a prior company, and there's zero advantage to being a first mover. I can tell you that, right? It's
tuition.
Exactly. It was a great learning experience, but you create the mold for other people to copy and repeat, and it's expensive. And I think it's also very hard in terms of financing these projects, right? To get people comfortable with what they view as potentially new technology, even though that's sort of debatable whether or not it's actually new, sort of basically a new asset class, right? And that's, a pretty big hump to get over.
Okay. Let's start with Guy on this next one. With respect to M&A for traditional hydrocarbons, are you guys seeing as, I mean, you touched on this a little bit earlier, but I really want to focus on it a little more specifically. The types of consideration that you're seeing in those deals, are you seeing public companies that, Devon aside,
Yeah.
are you seeing other public companies being more willing to use stock? And then when we get down to Blake for the second half of this, are you guys more willing to take stock as consideration for your exits?
Look, I think we're in a kind of shocking situation where even small E&P companies have a lot of cash at their disposal to go do deals. So I think we'll see stock in instances where you have a true merger, like we worked on the Colgate Centennial transaction, and that's, more typical to a corporate merger, even though one half of that deal was a private company. I think in the traditional A&D world, we'll be in much more of a cash weighted transaction approach. So if, it's a $5 billion company selling to a $20 billion company, I would expect that to be 80% cash in the same proportion. We sold a part of Titus to Earthstone, which is a small public company that was 93% cash, which at any point over the last 5 years would have probably been 90% equity. And so the amount of cash they're generating and how they think about their valuations, it's just changed the equation. And part of it is, look, E&P companies have always thought they've been undervalued from the beginning of time. And it's part of the reason we got ourselves into this whole mess. But today, what they're looking at is people are valuing me on free cash flow per share and ultimately on dividends per share. So issuing shares when you have a 30% free cash flow yield or a 9% dividend is different than you were issuing shares on the hope of growing 100% a year for the next 5 years and therefore thinking your stock is cheap. So there's real there's real corporate finance issues with sending out a bunch of stock. So from our perspective, and the private equity firms are really in a bit of a golden era. I mean, we got to get valuations right, but they have businesses that they can own and maintain for a long time if they want. If they want to sell them in general, you're going to receive a significant or all cash consideration. It's really just a valuation question at that point.
Yeah, I just say, I mean, at the end of the day, we're paid to send money back home. So getting cash is always a good thing. But we've taken stock in a lot of transactions as well. And it's typically transaction specific, as Guy highlighted, where are we in the cycle? What's the nature of the transaction? But we're comfortable taking stock and holding stock if that's what's required to get a deal done.
Yeah. Okay. So another question kind of for the group, as we see interest rates rising, we potentially are tipping over into a recession. How do you think the industry reacts to that? What does the market for hydrocarbons look like? What does the industry as a whole tend to look like if that were to occur?
I'll jump in with a few thoughts. I mean, one, I think the industry is in a very healthy spot today. So when you look at balance sheets, as Guy talked about, they can pay out cash for transactions because their balance sheets are in great shape. I also think the nature of the business model is changing into more of a, stay within cash flow, prudent development, more capital going towards productive assets versus non-productive assets like land. I think that's really only enhanced that. And so if we did go into a downturn, I think, it would be easier for them. One, their leverage is in a good spot, but then two, if they needed to ratchet back capital further, I think those are things they can do. I also think just distribution policies where most larger companies like Devon, the Devons of the world have erred towards more of a variable dividend is something that can scale with where commodities go. So they're not locked in to paying that out. So I just feel like the businesses are in a much healthier spot. Certainly they'll be impacted if we have a downturn, but I feel like we're starting from a good place.
Okay. Avril, do you have thoughts on that?
I mean, certainly to the extent interest rates are going to continue to tick up, money is more expensive. I think particularly, for deals on the margin, that becomes a real issue. Certainly, I feel I always say I'm very privileged to work at VTOL because so much of what we do is in cash. So less of an issue for us personally, but I think certainly you're going to see a lot more deals that maybe should not make. It's not always a bad thing.
Yeah, I mean, I think just two quick things for me. I'd say from an oil and gas perspective or traditional energy, I mean, I think we're certainly, our firm certainly generally more scared of something, let's call it catastrophic outside of a regular way recession, for lack of a better word. I mean, there's outsized events like what's happening in Europe, both with the currency and with energy supply. There's China potentially having another lockdown. Those sorts of things, look, lead you to, is there some issue like we had 2 years ago? I think a recession like we normally have at points in the business cycle, to Blake's point, the industry's well set up to handle. I think the interesting thing you'd have if we had a recession that felt like a normal course recession, where we already have more dialogue than ever, is on take privates. Look, the businesses are undervalued today. If we have a recession, it's going to generally mean less investment across the globe in energy, which again is part of the reason we've had high commodity prices now. So I think we'll actually have interesting thing comes out. We've gone through every recession and every downturn in our industry being highly defensive, having to sell assets, having to scramble to stay alive, having to restructure. And I think this would actually be an opportunistic opportunity for sponsors, for large public companies, for significant owners of public companies to take advantage of it through take private. So I think, unlike past downturns, I think this would be a much more, for a banker, a much more exciting one.
Yeah. Okay. Well, thank you all for your time today. We really appreciate the insights you've provided. You each have a unique perspective, like I said earlier, and so we really, really appreciate you guys joining us today and giving us your thoughts.
I'll help you here.
Well, thank you, April, Kai, Blake, and Wes. That was a very great discussion. Had a lot of takeaways from that. So as we're transitioning our panel, let me just take the opportunity again to remind you of the COE code for our online participant. It is 713 Energy, and you'll see it on the slide here as well. So with that, let's go ahead and jump right in. But if you wanted to grab a few drinks or refreshments, please feel free to move around in the room. Our second panel for the day is the view from Capitol Hill, spotlight in the energy transition. And we're delighted to have with us two colleagues of mine from our policy practice in Washington, D.C. today. To my right is former U.S. Representative Philemon Villa. Congressman Villa was first elected to serve the 34th Congressional District of Texas in 2012 and was reelected 4 times. During his time in Congress, Congressman focused on energy, infrastructure, commerce, agriculture, national security, defense, and economic issues. He joined the firm's Washington, D.C. office April of this year. Welcome, Congressman. And next to Congressman is Chris Traynor, our counsel in the D.C. office. He advocates before federal agencies and U.S. Congress on broad range of issues, including climate and energy policy. He did it before it was cool.
Never been elected, though.
Spent his time on Capitol Hill working on energy and environmental policy for the House Energy and Commerce Committee. So thanks, Congressman and Chris, for joining us here today. So I would say, each of the last mid-year briefing, we focused, we begin by focusing to the extent which the world has changed. And I would have thought we were going to be talking about after 2 years of pandemic, the reopening and all that stuff. But instead, I think we're going to kick it off first by noticing what's going on around the world today, which is how has, in light of the Russia's invasion of Ukraine, there are significant issues that we're faced today in terms of energy security and pricing around the world. So our first question, if you could lead in, is how has the war in Ukraine changed the trajectory of policymaking in Washington? And do you expect political dynamics to return to some normalcy in the near term? And will politics and policy continue to reflect, a rapid changing world? Maybe I'll start with you, Congressman.
Yeah, I think there's heartburn just all across the country on the rising gas prices. I think before the invasion, they were already on the rise to some degree, but the invasion certainly aggravated it. And I think that I think we're going to be stuck in this situation for a while. And I'm not too optimistic that there will be anything done from a policy level here in the near future to address that. I think, given the fact that we're just 3 or 4 months away from the midterm elections, I think that we're probably going to have to wait to see until after all of that before you start seeing policy action to address this.
Yeah, I think, one of the major changes we've seen is the Biden administration, from the campaign trail up through the first year has been focused on the climate crisis, as they describe it. And now we're dealing with several more crises. And so you see where the power center was in the White House was certainly focused on those working on climate change. And they had a all of government approach to have every agency focusing on climate change. Now suddenly energy security, energy independence, making sure that we're helping supply traditional energy sources to our allies has become much more important. There's been significant resistance to sort of that momentum swing within the White House and within a lot of folks in DC who, have spent their careers working on climate change issues and viewed this as the moment in time to make major progress. And certainly the Russian invasion of Ukraine, inflation and just, rising energy costs around the world have just changed the political dynamics in Washington, so that the conversation has gone back to a much more significant degree in how we can increase, production in a rapid period of time, while also, not abandoning some of the priorities around climate change that the administration has touted from the beginning.
Yeah.
Well, and I also think that the invasion itself was none of us really expected that. And I think it caught everybody off guard. And I'm not so sure that, even still, the administration has been able, because we weren't prepared for it. They're still trying to figure out what the right path forward is.
We've already noticed some, trend in our next slide on, how it has affected pricing. Do you want to speak a little bit on that?
Yeah, I don't, I would just say that there doesn't seem to be a short-term solution here for some of the crises that we're dealing with. I think that, sure, the prices are certainly going to come down from the incredible levels they've been at, but I do think that it will give pause to, politicians and policymakers about how rapidly the transition continues versus what kind of investments need to be made in, reliability and energy security in the U.S.
Sure. And there are definitely other macroeconomics factors contributing to pricing, obviously. And so I guess one of the clearest way that Americans are feeling this is the retail gas at the pump. And so the White House has called for a federal gas holiday. How likely do you think that is? Can you talk a little bit about that?
Yeah, I don't think it's very likely at all.
So I'm going to continue to pay $5 a gallon.
That would be my guess for the foreseeable future.
Yeah.
I just, and I think we're going to talk about Senator Manchin in a little bit, but I think his role in this is really critical, and I just don't see, given the fact that we're 4 months out from an election, I never really thought that was feasible to begin with. So.
Yeah, Speaker Pelosi has spoken against the gas tax holiday. Some Democrats believe that it wouldn't necessarily be passed down to the retail, consumers at the pump, and that it would result in windfall profits, which of course is, sin in the eyes of many Democrats in Washington. And so, the Biden administration is desperate. Certainly, we're obviously coming right up on a midterm election, which Congressman and I will get into later in the presentation, but they are, floating as many trial balloons as they can about potential ways this can, they can bring down prices. They certainly want to be seen as working hard on this and focused on it. I think that the pressure campaign on the industry will continue from the White House. I think, the refining executives and Secretary Granholm from DOE met and had what was described by both sides as a constructive conversation, but much like, natural gas and oil prices, there's no immediate term solution for these things. You can see up on the slide some of the ideas that have been thrown around: Use of Defense Production Act, Jones Act waivers, repealing the requirement of changing to the summer blends for gasoline, crude and refined, product export bans, and then the gas tax holiday. I don't think any of them are realistic.
Really?
In the short term, I think that the political fallout would outweigh the benefit to consumers.
So I've been hearing about the Defense Production Act. It seems like the administration has used that in other contexts, maybe not so much directly with the gas prices. Do you think you also think that's unlikely to be using that as part of the tool?
I think to the point Chris is making in terms of some consensus that the talks with Granholm were semi-constructive. I think if they were to do that, there wouldn't be no further constructive talks. So, and I think they're well aware of that. I don't see the administration going down that route.
Yeah, Defense Production Act. I mean, it entered, the conversation in DC around the building the wall, and Trump's used the Defense Production Act there. It hasn't been tested in the courts. It's very broad powers. Obviously, it's meant to be used during wartime for, various national security purposes, but there's no definition of what wartime is, what is not in the interest of national security, and no limitation on the president's powers under that, from the courts anyway. And so I think it's important to keep it in the back of the mind in order to sort of be unable to eliminate any of those ideas that I mentioned earlier on gas prices or on, climate change or energy security, that, the Defense Production Act is always there in the back of the mind of us in Washington. And the fact that it is such broad authority and hasn't been challenged in courts means that it can be used, for political purposes, but also, can be used creatively. I think at this point, there's no scenario, maybe where it works, because refining capacity is so limited. The time it would take to, bring back online shuttered refineries, wouldn't result in any political benefits by the midterm, certainly, and probably would take a long time before it actually affected retail gas prices. So, without refining capacity, none of the other really DPA, Defense Production Act approaches really make sense.
Yeah, it sounds very fancy and it sounds like a very powerful tool, but it sounds like it's an idea merely.
Yeah, that's right. But I will say that desperate times, in the White House certainly mean that, they're looking at it to see if creative ways that it could be used to at least, pressure the markets.
What about like increasing supply? So for example, what is Biden's policies towards oil and gas leasings and maybe offshore drilling, for example? Have you seen more support of that, or still taking a very aggressive view?
Let me start. Yeah. I think this is certainly playing out in the negotiations with Senator Manchin, which I'll let the congressman speak on. But it's they're floating right now the idea of increasing, leasing capacity. They put out the 5-year plan a couple weeks ago, which offered a number of scenarios. But I think, fundamentally the center of gravity in the White House remains with, environmental minded, climate minded decision makers. And so I would expect that the oil and gas leasing will comply with the law. And, Congress has mandated that they hold some oil and gas leases offshore and on federal land. So I do not expect that President Biden's campaign promise to eliminate all oil and gas leasing on public lands will ever come to fruition, but I wouldn't expect them to do anything beyond what is required.
Yeah, and I think you have to go back to the point at which Biden won the Democratic primary election. If you'll recall, to some of us, it was kind of a surprise that it happened that quickly. There was an immediate move to consolidate the party and mend whatever negative relationship there was with Sanders and the Warren factions. And so what ended up happening once the administration got populated, a lot of the people from those campaigns came into the system. And so a lot of those voices are what the administration has to contend with.
Yeah. So sounds also like near short term, the supply and pricing will stay as it is. And there's not an interesting tools or theories out there to kind of help alleviate, and he's going to continue to feel a lot of pressure.
Yeah, to the extent that the White House is trying, a friendly pressure campaign, I don't think the industry is going to feel a great sense of urgency you know, make major investments without promises that the administration is not going to be bashing them a year down the road.
Well, and
Or-
given oil prices, it's difficult for them to decide to make those kinds of investments in refinery capacity because it's too unpredictable.
Well, turning to a different topic, we also seen there's a lot of going on in the SEC world in terms of disclosure rules, and we've seen public comments period for the SEC climate disclosure rule recently closed with thousands of comments. And so I have to figure that there's a reaction from Washington about that. Do you anticipate somehow this plays into the midterm election as well?
Yeah, I would say that the SEC climate risk disclosure rule is the most ambitious item remaining in Biden's toolbox in terms of executive powers to affect, the trajectory of the economy. I think because of that, we'll talk about it in a couple slides, but the Supreme Court may have something to say about the ability of taking this action. But, it is far reaching, and it touches every corner of the US economy. It doesn't just apply just to publicly traded companies. It's going to affect, we had a briefing the other day with potato farmers who are worried about having to report to Kroger, their the scope 3 emissions for Kroger and various aspects of it. So it's such a massive rule touching so many different companies. I think that there's going to be a lot of heat in Washington as this comes down. I think that the Biden administration, the SEC are fully aware of the challenges that are going to come, and they're going to be trying to, craft this in a way that can survive court challenges. But, as we'll talk about in a second, the West Virginia versus EPA Supreme Court decision on the major questions doctrine will potentially gut the SEC proposal. But, the SEC has gone out of its way to talk about the materiality of climate risks. And so, they certainly have the authority to regulate that, those material disclosures. And so I'm not going to be placing any bets on how that court battle goes, other than to say it will be a court battle and it'll be protracted.
Any further insight?
No, Chris is our SEC energy expert.
Well, I was going to make a plug that the Akin Gump corporate team could also help you in
right.
answering some of these disclosure rules.
Yes.
I would just add, it's a little bit unrelated, but back to the previous conversation in the panel before us on the 45Q tax credit. I would point out that there is a bipartisan piece of legislation to increase it by Senator Lujan and Senator Barroso, I believe, I'm not mistaken, right? And I think that's something to watch. It may, if not here by the end of the year, for sure in the next session of Congress.
So one of the sort of few constants, I guess, if we're trying to think what we talked about last year's in this mid-year energy briefing compared to this year's, is his Build Back Better plan. And where does it stand? And what kind of impact would either the passage or failure of Build Back Better have on the energy sector? Is it still cool to talk about it?
Yeah, it's certainly relevant, and I can tell you all about it because I was there for the first Build Back Better debate. And the debate at that point, if you will recall, was the progressives insisted on tying the Build Back Better package to the infrastructure package.
Mhm.
And 9 of us Democrats in the House resisted that effort. And we took a lot of heat for it. I mean, millions of dollars were spent in our congressional districts beating us up over it. And during that time period, I lose track of time, but I think it was last summer, like August, July, August,
At
September.
this time.
I mean, I was living it in real time.
Mhm.
And, the 9 of us were lockstep with Senator Manchin and Senator Sinema. And I mean, frankly, I just thought it was one of the stupidest things imaginable to condition the passing of an infrastructure bill that had bipartisan support in the Senate, not bipartisan support in the House, because there was hardly any Republican support for the infrastructure package itself. But the idea of tying the two together just, it never made sense to me. And we lost 3 months of time because of that internal battle inside the Democratic Party over whether we should, pass them together or not. The administration's efforts lost a lot of traction. Sure enough, 3 months later, we're right back to where we started. The right thing was done. We passed the infrastructure bill, but then the blood was so bad with respect to Build Back Better or the components of it that made up the package at the time that there was no way that was going to pass. And then Senator Manchin made it real clear in the late fall, and ever since then, there has been this chatter that it's going to revive. Well, as we were sitting here, I think Senator Manchin made clear that it's not going to happen because, in the last couple of hours, Senator Manchin basically said, if there's going to be Build Back Better, I will only likely support it if it's limited to legislation with regard to drug pricing, and does not appear to be willing to address energy issues in the Build Back Better package.
Yeah, I'm a little more optimistic, but I also haven't read that article yet, so maybe that'll change my mind. But I talked with Manchin's staff yesterday, and optimism, reigns supreme in DC because you jump off a bridge if you weren't a little bit optimistic in Washington DC, and so they're still staying up late nights. I would say that it's a good faith negotiation going on between Schumer and Manchin. I think Manchin would prefer to have the White House completely out of the discussion, which is not necessarily an option for the president, of course. But to the extent that it does come together, it will be none of the punitive measures that have been discussed will likely be in there. I think there will be a methane fee. I think it would be something that would not be terribly difficult for the vast majority of the industry to comply with. But there's potential permitting reform being discussed by Senator Manchin too, which could be exciting for parts of the industry. And then much of the clean energy tax credits that have been discussed likely remain, although direct payment options have been removed. Much of the electric vehicle incentives are being stripped away by Manchin. So the package is less than half of what it probably was when the congressman voted for it almost a year ago, and I think it is continuing to shrink. Manchin wants to make sure that it is deficit or that it decreases the deficit, and so that's going to it's tough to do that without raising taxes, and it's really inconvenient to raise taxes right before a midterm election. So
I think it's shrunk. And I think there's some practical realities. First of all, Congress is only in session till the end of this month, and they're out all of August and they're out all of October. So there's hardly any time left. Second, COVID. Schumer himself is not even there because of COVID, and I think a couple of other Democratic senators are not. And with 50-50 margins, makes that difficult. And then, I think what drove Manchin's comments today is the news on inflation increasing, right? So I think all those factors mitigate against any sort of deal coming together, but I could be wrong.
And we should say, as it says in the slide, September 30th is when Democrats lose the ability to use the budget reconciliation process. It is a budgetary process. So it goes from by fiscal year. There's an entire long, antiquated Senate obnoxious process you have to go through in order to use budget reconciliation. And so once the fiscal year ends and we're in a new fiscal year, we won't be talking about Build Back Better anymore. It'll be over. So really September 30th is the deadline to see this happen.
But if anybody wants to talk about the drug prices, our healthcare expert out here, Julie, is somewhere out here.
Yeah, and
I put her on the spot.
And as controversial as some of the energy stuff is, Democrats desperately want to be able to go home and talk about the prescription drugs and Medicare and things like that. So there are reasons why some Democrats would want to vote for it.
Yeah.
A lot of reasons why some Democrats would not want to vote for it.
So just to be clear, the September 30th, no more Build Back Better or the Build Back Mansion, like all of
No
it
more.
off the table.
No more. I mean, we'll be building back mansion until,
Yeah, I mean, the ability to pass a
while.
bill with only 50 votes, 51 votes in the Senate expires
that's right.
by rules on September 30th.
So Chris, coming back to a case that you mentioned earlier, I'm not too familiar with that, but definitely the US Supreme Court has a lot of activities this summer. This case that is in the next slide about West Virginia versus EPA decision, maybe you could lay some groundwork for us on that and then talk about what does that affect Biden's administration's ability to advance some of its more ambitious policies?
Yeah, I think that this is going to be a major unfolding, story as the Supreme Court will be citing this case for a while. And I think that 6-3 number is something we're going to be getting used to seeing a lot. But this case, West Virginia versus EPA, goes back to the Obama administration's Clean Power Plan, which is something that had been stayed and hadn't been enforced by EPA. So, this was not really a case about that specific plan so much as those of us watching it trying to predict what the fallout was going to be from this case. And the court, decided to strike down the Clean Power Plan, which was the Obama administration's ambitious climate regulation through EPA, struck it down because of the major question doctrine. So, the EPA and federal agencies only have the powers that Congress give them. The argument was that, or the court found that that Congress had not given EPA the authority to regulate in the way that they did. You could also make an argument that Congress hasn't given the SEC authority to, regulate climate change, whether it's your position that that's what the SEC rule does or not, will certainly be an interesting one. But there are other, decisions about, FERC's assessment of interstate natural gas project emissions, and a number of different areas. But the bottom line is, obviously, nothing can get done in Congress these days because of the divided government or the narrow majorities. And so Democrats have been looking to the administration to take aggressive executive action. And I think West Virginia versus EPA will significantly curtail the ability of the administration to take executive action where Congress hasn't explicitly said that it has the authority to take that executive action.
And is that going to impact the FERC's assessment, like on your second bullet there?
I think it will. We're still trying to figure it out, and I'm sure there are academics out there that are getting into this. But I as a lobbyist, I count votes, and that 6-3 to vote. That 6-3 count is a vote that I think we can expect to see a lot of frequently in the future when it comes to challenging executive orders from the Biden administration.
And I think a lot of us in the audience are very curious about the midterm election that is coming up and how that is going to affect whether it's energy policies or, in the last panel, we talked about market trends, but a lot of these will be impacted by, the election. So give us your crystal ball.
Yeah, I think before the abortion decision, I would have sat here and told you that I would not be surprised to see Democrats lose anywhere between 20 to 50 seats in the House. Almost a foregone conclusion that we were going to get slaughtered. But the abortion decision may mitigate that. I mean, I think some people still think I'm a member of Congress because I get the nasty texts and still. And what I am sensing is that there and it's an open question as to what the impact will be at the end of the day, but there are a lot of women, particularly in the suburbs, that are that are pretty worked up about that decision, and that may mitigate some of the losses at the end of the day. And I think, especially in big city suburbs, in particularly like in Illinois and maybe in California, where Republicans have won some of the swing districts. I think seats that were to me, it was a foregone conclusion a month and a half ago. We're going to be lost, may not be lost. And I'll let you weigh in on the House, and then we can talk about. the
Yeah,
Senate.
we'll go to the next slide. This is a chart from the Cook Political Report, which, you don't need to pay attention to the names, but really the key thing is where the blue names and the red names overlap. And there's a lot more blue names moving to the right side than there are red names moving to the left side, which means that Democrats are in trouble. So
I'm just glad I'm not on there.
I'm sure you'd be in a safe blue. It's but it's what, a three seat majority now for Democrats, and so it's impossible to see a scenario from my perspective where Democrats don't lose the House of Representatives, which obviously changes the political dynamics in terms of what can get accomplished. Legislatively, I would say, if Republicans win back the House, then Biden's climate legislative agenda is dead, and Joe Manchin will continue to be incredibly important, but so will 10 other senators that will be needed to pass anything into law. So it's going to be extremely difficult to find, compromise solutions, but, there also won't be the same type of extreme swings and, the political dynamics that we've seen over the last couple election cycles.
Well, and at the margins in the House, if Republicans take over and the margins are not all that great, if you have a 5 to 10, 15 vote Republican majority, then the Democratic centrists become pretty pivotal too. That's kind of what I'm hopeful for, because those were the people I was aligned with when I was there. And I'd like to see power within the Democratic Party shift to the center.
Yeah. That the last bullet here just has some interesting, sort of thoughts I've had on where areas of compromise could come together, because, Joe Biden, to his credit, is a negotiator and has, spent a lot of time in the Senate, obviously working across the aisle with Republicans. The political dynamics in Washington have changed dramatically since he was in the Senate, certainly, but there will be areas where I think Democrats and Republicans can come together. I think permitting reform, LNG exports, carbon credits or incentives for agricultural practices, or money handouts to farmers, and then technological investments, whether it's direct air carbon capture or any CCS, that kind of thing will be much more attractive for policymakers to focus on and to come together around, because fundamentally, there are many people that go there for the wrong reasons, but most of the members are there to make laws and to find compromise solutions, and sometimes the national politics don't allow that to be the case. But I think there's enough adults there in Washington that they will quietly legislate on some of these smaller issues, while allowing big food fights around and mudslinging around buzzwords like climate change and things like that. But there will be areas where there are compromise. The solar and renewable developers are having trouble with permitting and develop and siting, much like having issues with pipelines and things like that. So I think that there's room for some grand bargains, as long as they don't get too much attention. As long as they're done in the quiet, underneath the surface, they'll be fine.
So do you think it's going to affect how the SEC is going to continue to take its direction on the disclosure rules?
I don't.
That's just legislation. This
Yeah.
is sort of standalone.
Yeah, I think the Biden administration will continue to be as ambitious as it can until the courts tell it that it can't be anymore. Yeah, I don't think that the SEC, Republicans, if they win the Senate, and have enough, they would try to, repeal or make clear that the SEC doesn't have authority to implement a climate rule, but Biden would veto it. So I don't think there's any issue there.
Yeah, and I think, speaking of the Senate, I think that's kind of an open question now. I mean, I think you have to remember what delivered the Democrats the Senate were the 2 seats in Georgia. And, I think 3 months ago, most people would have told you that clearly Republicans would keep Georgia, but the Herschel Walker campaign is not going very well, and Republicans concede, I think, that they've got real problems there. And what's interesting about the Senate is all of a sudden because of the candidates that are winning Republican primaries, like we'll see soon, I think, in Missouri. But you have these real interesting dynamics in Pennsylvania, where Senator Toomey's seat is now coming, up to decisions for voters today versus, between Dr. Mehmet Oz as a Republican and Fetterman, who is, seems to be wildly popular. And then we have Tim Ryan, a more moderate Democrat in Ohio. I think that there may be some play for Democrats that we didn't think was there before. Saying that, you've got places like Nevada that Democrats control the Senate seat, and I think the economic impact over the last several years in the state of Nevada is going to make it more difficult for Democrats to hold on.
Well, given sort of the already estimated sort of outlook of how the midterm election is going to play out, couple that with the September 30th deadline, I mean, you really got the next, 60 to 85 days to kind of get things done.
Yep.
Any lasting remarks before? I know we got a couple more slides on some of the energy programs, but do you want to cover any of that before we go into the Q&A sessions?
No, just the bipartisan infrastructure law.
Is there anything important to point out here?
I can tell you what we're seeing, and Chris is a lot more familiar with the details of the programs, but lots of clients coming to us with respect to information and access to the hydrogen hub programs that are part of the bipartisan infrastructure law and the carbon capture.
Yeah. Yeah, and the EV batteries, we've done a lot of work on there on the DOE grant side. It's going to be, there's a lot of money in there to be handed out, and it's going to be very competitive. A lot of these, some of these EV battery grants are a minimum of $100 million grant. They're only giving them out to 3 folks under each category, and so it's going to be very competitive. But there's a lot of money being handed out in Washington right now, so we're very busy, getting folks positioned well to take advantage of those grants.
Yeah, but it's also taking the administration some time to roll out the application processes. So, we're monitoring that very closely.
Yeah, the Department of Energy is hiring 1,000 new workers, and as everybody knows, who's trying to hire workers, they're not easy to find, even in the federal government.
Do they give remote working options?
Sure. Yeah, you bet. You bet.
Yeah, right now there's still a lot of remote working going on in Washington. I mean, it started to come back, and then with the rise of the Omicron surge, more and more people are getting used to working at home, including in our office.
For sure. Well, thank you, Congressman and Chris. I think that's always an interesting discussion to hear someone working so closely in DC to bring that information down here and share insights with us. So with that, that concludes our second panel, but stay in your seats. We are going to transitioning into Q&A for actually both sessions. So for those in-person audience, you can simply raise your hand and we'll bring the mic to you. And then to the extent we have Q&A webinar participants, go ahead and submit your questions through your online chat functions.
Yeah, I think we need one more chair.
Do you have any questions in the audience? So I got a couple of these from the web. Figure this out real quickly. Maybe this is probably a policy question for you guys. Any thoughts on why the US is friendlier to foreign oil and gas than domestic?
I'll let Chris
Any
answer
idea?
that.
Yeah. I don't know. Do I have a lawyer who could object to the form of the question? Yeah.
Objection.
No, I don't know. I assume the question has to do with,
Objection leading.
imports versus refining capacity. Now, I would just say, one of the fundamental problems we have with climate change and the nationally determined contributions, which is the UN, climate, Paris Agreement, is that they keep score, around borders. at where climate change is a global issue, right? So to the extent that, you can refine and, produce oil, in a way that's regulated and more environmentally friendly here than you could in some other places, we certainly should be looking to that. But the nationally determined contributions and the way they're set up do not really allow for that kind of global thinking when it comes time to, measuring US emissions and measuring US emissions reductions and all the important, old folks getting together in all these fancy cities to talk about how great they are about saving the world. They just, it's not, and so for that, to that extent, there sometimes can be blinders on, in DC about what is important in terms of getting the US score to be lower when it comes to emissions and what actually, is important for global market dynamics and for, solving the global climate crisis to the extent that's a priority.
I think it goes back to what I said at the beginning with respect to how the administration was formed after the primary. And in the Democratic Party, there is lots of internal strife between the centrists and the progressives on this issue, and the progressives are winning. And I think that is what has put us in a situation where the administration is now looking to foreign interests.
Fair. And then the next question has to do with the LNG. So the U.S. is the largest natural gas shale reserve in the world. So to what extent is the Biden administration serious about expanding U.S. LNG to help allies in Europe? So going back to the global view of things, are you aware of any specific measures that they're considering?
They are certainly, this goes back to the original question to begin the conversation. This is not something I thought we'd be talking about in January. But yeah, the administration, is aware of the reality in Europe and around the world about the need to, get more liquefied natural gas in order to wean our friends off of the Russian supply. It's also going to be critically important to avoid bringing coal plants back online, which we're seeing happen at a rapid pace because of shutdowns in Russian gas flows and for other economic and inflationary reasons. But I certainly do think that the political dynamics in the administration have shifted dramatically, and I don't think they're going to shift back anytime soon. But the green groups and the environmentally minded folks inside the administration are certainly pushing back on the narrative that liquefied natural gas is a solution to some of the problems that we're facing. But I was certainly encouraged to see that the European Union in its environmental taxonomy, determined that both nukes and natural gas can, in some circumstances, be considered green because of the way that they replace coal or supplement other dirtier sources. And so I think there's sort of, liquefied natural gas is not something that many people in Washington understand or even know what it stands for. And so there's been a massive need for education and better understanding. I think the administration had very few people inside of it that fully understood LNG, markets and sort of how we could go about ramping up and helping our allies overseas. So I do think that there is going to be a change in the approach from the administration, but there are not the short-term solutions, to help Europe this winter that we hoped there would be. And so I think we're going to be looking towards bipartisan permitting reform and some, other avenues that will not happen this year.
Yeah, I think that's one spot where where the struggle may eventually sway the way of the centrists, and Chris is leading a lot of our efforts in Washington on that effort, and I think that it remains to be seen where it plays out. So it's kind of work in progress. I mean, we're working on that pretty much every day.
Yeah, it's a tension between sort of the economists and the politicos in the White House who see how important these prices are for elections, and the economists who see, that energy prices are such an outsized impact on inflation between them and folks who, really think that any response we have right now to this energy crisis will lock in, fossil fuels for the next decade or several decades. And so it's a real tension playing out in real time in Washington. Right now, we're not really sure which direction it's going to go in, but we're certainly playing in that space.
And
Yeah, and this is like oversimplifying the issue, but if you can imagine going into a room where this is being debated internally in the White House and you have 10 people, there may be two, arguing for the LNG industry in that room, but there's 8 people fighting against it.
Mhm.
But hopefully at some point, everyone will come to their senses, 6 months down the road, probably, right? And I do think there's some opportunity on that front.
So another question from the web kind of ties in the same theme is also any thoughts on the future of nuclear energy? So is that another form of, getting energy security?
Yeah, I do expect that production tax credits for nuclear will be in Build Back Mansion. Whether that gets signed into law or not, will be determined. But it's taken a long time for sort of the conversation to evolve around nuclear. But of course, it's such a massive, potential for carbon-free electricity and power generation that I think it's inevitably going to be part of the conversation. I can't imagine when it's not going to be part of the conversation anymore, but we don't have the solution for nuclear waste. Right now, it's, nothing has changed about the conversation around nukes for the last decade, since I, was working on them 15 years ago. It's the same problems. It's the same sort of lack of solutions, but, there's a lot of investment, including in the infrastructure bill, into advanced nuclear reactors. And so, there's some hope that there could be, some permitting allowed and some investment that's attracted in order to build these very expensive and somewhat controversial, advanced reactors.
Yeah, I just think there needs to be a lot of education on that front. I mean, because the media reports the word nuclear and immediately the first reaction though is it's not safe, but we know now that there has been a lot done in that context to make it a lot safer. But the public doesn't know it yet.
Yeah, I would say, one of the things that is happening immediately is just, every state and the federal government seems to be focused on avoiding the retirements of these facilities. So to the extent that there are nuclear reactors coming up on their retirement age, I think anything can and will be done in order to make sure they stay online, because there's no rapid way to replace that carbon-free energy other than with coal and natural gas right now. And, in blue states and in the administration, that's not something they want to see happen.
Do you have any questions for the other guy?
So I'm just curious. So the people who think that we're going to not be hydrocarbon dependent in 10 years, help me out. How does that happen?
They're working backwards. They see this is where we need to be on emissions reductions, and the only way to get there is to eliminate, hydrocarbons in X amount of time period. And we're in a crisis, and so whatever it takes, it's worth it. And whatever that price ends up being, it's worth it because it's a global crisis. And
And the
honestly, it's
replacement will just happen.
what's that?
And the replacement will just happen.
Yeah, absolutely.
They just don't have a realistic
Yeah,
view on it.
Yeah.
Wanted to make sure I understood the position correctly.
Yeah. There's certainly a strong keep it in the ground, movement.
Well, it's these interest groups too that control a lot of the dialogue within the party. It doesn't necessarily reflect the majority of people in the party, but the money and the politics drive it so that everybody gets locked in, and we lose our heads over it.
Yeah, it's a pendulum too, though. To the extent that there's overreach in that direction, you're seeing inflation right now and crazy energy prices, and that is contributing to, less momentum for the keep it in the ground folks and more momentum for some of the centrists that the congressman referenced.
It might sober them up when we're in the minority by 20 or 30 votes.
Yeah.
Well, thank you, Congressman and
Thanks.
Chris, and thank you, April and Blake and Wes for being our panelists. I guess Guy has left. That concludes our programming today. Oh, is there one more question? Sorry.
Just quickly, so for my Democrat colleagues over here, after seeing what's happened in Europe and Germany having to bring plants back online and kind of the green movement, seeing the reality that's faced from war, from inflation, from prices, global economy, right? What's the reception from Democrats in Capitol Hill to this realization? Are they accepting the fact that they have to take this into account? Is it more of a national security angle? Or will they be receptive to it at all when their neighbors that they turn to put this global effort forward is now facing kind of having to go back? Do you see any type of reception from the Democrats on this? I know things are going to change and after November, but is anything like this on your radar?
I don't think members are paying attention to it right now, to that particular issue yet, because there's so much other stuff that they're dealing with at the moment and so little time to do it. That's kind of my gut on it.
Yeah, I mean, we're getting, to the extent that I'm up there on the Hill, there is a lot of traction that we're getting, talking to moderate Democrats about, the need to deal with energy prices, the focus on their constituents, caring much more deeply about energy security and energy reliability than they did, 6 months ago. And so, I think the Democratic members are reflecting the voters who are very anxious about, the increased prices that they're paying at the pump, they're going to be dealing with a rough winter when it comes to heating their homes, likely, certainly in the north. And so, there has been a reception, but there's also a resistance. They've spent a decade, trying to bring folks along on climate change, and so change doesn't come easy when it comes to that attitude. So there are some really thoughtful members up there that are trying to thread the needle of finding ways to expand traditional hydrocarbon development while also making sure that it's not going to make the climate crisis worse. And so that's why you're seeing a lot of focus on methane emissions right now from moderates, and seeing folks talking about HFCs and some of the super warmers as they refer to them. But yeah, I think those that are on the wings of both party will remain on the wings of both party, and we'll just try to make sure we got as many moderates as possible. We have fewer and fewer every election.
We good? All right. Well, thank you very much for joining us today. That wraps up our program. And again, the CLE code, if we post it here, it is 713 Energy. And we'll post today's recording on the link and you'll receive it in your email. And finally, thank you to the members of media who have joined us on this on the record recording. And as always, feel free to reach out to any of the Akin Gump members for any follow-up questions. Thank you and have a good rest of the day.